Good morning, Christian. Good morning, Ladislav.
Hello.
So we are still 2 minutes early, and I'm gonna give some more minutes for the others to join. I think our president is joining as well.
President Jella, you want to say?
Jella, yes.
Okay, great. Yeah, yesterday, unfortunately, I had a strong, sudden problem with my stomach. I do not know why.
Getting better?
Sometimes. Yeah, thank you. Yes, I think now it goes. It's okay again. Yes.
Good.
And yesterday it lasted the 2 hours you had planned, yeah?
Yes, 2 hours and a bit more, 20 minutes more, I think.
Oh, yeah, okay.
Yeah.
Oh, good.
Hello, Ellen.
Do you want us to turn off the camera and the microphone or no?
The microphone, yes, but once we start, for now you can keep it open, no problem.
Okay.
Good morning, Elizabeth.
Good morning.
So we will start in a couple of minutes. I think we're still expecting some more members to join.
Very fine. I just want to say that I'm not the one in charge for this, but I've been asked to listen to your conversations.
Okay. In any case, this is recorded, so if you need to show it to colleagues and discuss some particular points, you will have the material.
Oh, great! And is that the same for the one in yesterday?
Yes, we will put that online probably tomorrow, and send the link to all the members.
Okay, great. Thanks.
Okay, let's give them until 9:35 to join, and then we will start. morning, Jelle.
Good morning, Sebastian. Sorry for being late.
No problem. I was just saying to the others that we'll wait 1 more minute.
Yes, Christiane excuses herself, but she has to work actually on the Better Climate modules. So she has a good excuse working for Better Finance.
Yes.
Yeah, hello, Jelle. Today I'm on board. Yeah. Yesterday I had a problem with my stomach, unfortunately. So
yeah, we missed you yesterday because there were 1 or 2 questions, Sebastian, which were directed to insurance things.
Yes.
Huh? IDD. Mm.
Yes. Fortunately, we had Jean Berton, who is more of an expert on insurance than I am. So he was able to fill the discussion on those issues. But yes, we did miss you.
But he did not join today. He will not join today, Jean?
No, he's not joining today.
Mm-hmm. Okay.
It's quite difficult, I think, for most people to reserve 2 mornings in a row.
Yeah. But I say hello, Helen, and hello, Desislav, and hello, Lisbeth.
Okay. I suggest we start.
Yes.
Okay. So yesterday we saw a short introduction of what the risk is. Then we discussed conflicts of interest and value for money. The video of that session from yesterday will be online probably tomorrow. So you will be able, if you missed it, to watch it, and if you participated but need to check something that we said, to watch it again. Today we're going to focus on the information to investors, so pre-contractual information, the rules in MiFID and IDD, especially on costs, as a key information document, which is slightly reformed by the proposals, and the new annual statements to retail investors. And then we have 2 more issues that I really want to discuss with you, which are the qualifications of advisors, which also, the rules are also modified by the retail investment strategy. And finally, a point that may be limited in terms of number of rules concerned, but very important, I think, to us, is client categorization rules. So professional versus private investors and the possibility to switch from one to the other. In terms of practicalities, all participants, please keep your microphones muted when you're not speaking. And if you wish to intervene, you can ask to begin on the floor by clicking the little hand on top of your screen, and I will see that you want to speak. You can actually keep your cameras on. It's more lively to me, but no obligation. Thank you, Jelle. So this presentation and all our discussions are intended only for Better Finance members. So please do not share any details outside of your organizations. Just goes better with saying. And this webinar is recorded for us in order to make it easier to then give our thoughts and draft a position paper and proposals for amendments, but also for the members to be able to rewatch or catch up on what they missed. This recording will be kept confidential, so it's only for the team and the members. Like the discussions, no sharing outside the organizations. Some announcements that I've been tasked to share with you is that we are creating actually some kind of an intranet for members, a members portal on our website, where we will put all the documents that we send you, all the surveys, all the draft papers, draft publications, and also information about our policy activities, background information on the policy issues, and items such as this webinar, the videos. You will be able to find that there. The idea is really to have a single access point for the members to track the activities of Better Finance, especially for the members. You will be notified by email when we add content on in that, a new survey, a new document that we'd like you to review. So the videos of this webinar will be uploaded there, probably tomorrow. And I really have to mention that this is a work in progress. So this is really a beta version. Content will be added progressively, and we will refine the way it's presented, the way it works, also based on your feedback. You will receive the address of this website and login details in an email, which will probably be sent tomorrow. So you will be able to access all that. So on to information to investors. So we're going to discuss pre-contractual information, the key information document, and annual statements. It's quite a piece, so bear with me. It's not especially complex, but it's a bit long. So we will have a lot to review. So in terms of the pre-contractual information, here I'm really talking about the rules in MiFID and IDD, not especially the key information document. Those are two separate things. What the risk proposal is introducing this idea of risk warnings on particularly risky financial instruments. So financial instruments for MiFID, EBIPs for IDD, but the wording is the same. So here we have coherence between the two pieces of legislation. It's to be included in all information materials, those warnings, including marketing communications. So exactly how this is to be done for marketing communications, for instance, is not defined in the proposals. It will be defined in guidelines by ESMA and EIOPA. So is, and that's more problematic, the definition of particularly risky products. Hello, Florian. Right on time. We just started. We are discussing information to investors.
Thank you.
And so I was starting with the introduction of the new risk warnings on particularly risky financial instruments. So the definition is not introduced in the directives themselves. It's left for ESMA and EIOPA to define in guidelines. Of course, guidelines are not legally binding. It's a guidance for national competent authorities and for firms to interpret. Yeah. In terms of the format and content of the warnings, that will be defined in regulatory technical standards that are legally binding. And in terms of supervision and supervisory powers, so the national competent authorities will be empowered to force firms to use these warnings where they find it necessary. So if a firm does not, markets a complex product, particularly risky product, and doesn't put a risk warning, then the national competent authority can say, please add a risk warning. ESMA and EIOPA will monitor the use of those risk warnings by firms and the use of supervisory powers by national competent authorities. And if national authorities fail to act to impose risk warning where necessary, ESMA and EIOPA will have the power to impose it themselves, to shortcut or bypass the national authority after having consulted them, but still. So, well, a set of questions for you. First one is, what types of products do you think should be deemed particularly risky? A priori, some categories that you already identify as particularly risky and where those risk warnings should always be used. And then we could mention already that in the directive. should the definition of particularly risky be embedded in legislation, so either in the directive on delegating that, or at least in regulatory technical standards, or is a guideline sufficient for that definition? Then another innovation in IDD, as well as under MiFID, is that the pre-contractual information will be given digitally by default. It's already the case in MiFID. So the by default format is digital, electronic, and the paper version is to be provided upon request. So it's new for IDD. The proposal is really taken from MiFID into IDD, with a right to consumer to keep receiving the information on paper free of charge upon request. And the distributor is required to inform the client of that right. So our analysis is that those are sufficient safeguards as long as you can have the paper version for free and you are informed of that right. We don't see any major issue with making digital the default format. Digital being, usually a PDF document that you receive by email or that you download. So what's new regarding this digital format is that ESMA and EIOPA, so that's also new for MiFID, ESMA and EIOPA are to prepare guidelines on the presentation of information in electronic format, so that the information is presented, I quote, in a suitable way for the average customer to whom the information is directed. That was not specified in MiFID. Now it would be that an obligation for the providers to use a suitable way, a suitable format for the presentation, which I think we can welcome. Just greeting Ben and Christian. Thank you for joining. No problem. So we are discussing information to investors, and particularly pre-contractual information. I mentioned the introduction of risk warnings on particularly risky products, and the switch to a digital format by default for insurance products. So our question on that is basically, do you agree with digital by default also for EBIPs? And are there particular safeguards that the guidelines should specify in terms of the format of the presentation, the way information is presented? So I give you the floor. Any reaction to that? Start with Yela.
Yeah, I just have a question, maybe a stupid question. Can you give us an example for the particularly risky financial instruments? I mean, I would think as, I don't know, derivatives or something like this, but I have no idea.
So actually, the only example that I could provide is one that was given to me by Christian Gulich, so maybe I'll let him speak.
Okay, maybe Christian can explain.
Yeah.
Okay, yes, thank you. In fact, that is exactly the question which I had too. And first,
sorry.
No, it's very good. First, I would say what is necessary in the consideration or in this whole analysis, that we should, from my perspective, as we are policy holders representatives, I think we should make the difference between investors and policy holders. And because in the first slide you only spoke of investors, and okay, that is clear, that is necessary for MiFID II, for the MiFID II context, but policyholders, I think, per se have a different position to all this question of investments. And you can show it here with regard to the particularly risky financial instruments. My proposal, for example, for investors would be, for retail investors, that, only the so-called structured retail products, or as you have said, Jella, the derivatives are really risky products. But this category of products, for example, is not relevant at all for policyholders. When we think, as you know, in life insurances, we have now hybrid products, we have products with guarantees or reduced guarantees, but I wouldn't say that these are really risky products, even if the guarantee is reduced. We could say that, for example, unit-linked products are, of course, more risky for policyholders, but again, I would say this is not, if you take a usual investment fund, these are not really very risky products for retail investors. And again, for example, with regard to policyholders, we have not only unit-linked products, there are index-linked products. And index-linked products, which are based on a certain index, Euro Stoxx or DAX or whatever, or CAC. And now what makes them really more risky is not the fact that they are based on the index, but the way how the bonuses are redistributed to the policyholders. And this, there are sometimes, it depends on the company, on the insurance company, how this mechanism of redistribution of bonuses, which are generated, of course, by the index, are defined. And then you have to watch or to analyze very exactly the wording of the contract, how this is made in any singular case. And that is the real risk. So, or risk, entre guillemets. so that is the difficult thing. So that's why I would say that the problem of risky, particularly risky products in the MiFID sector and in the IDD sector, or let's say in the retail investor sector and in the policyholder sector, are really very different. And we should take that into consideration and be very clear. If we look for a definition, what is here said, there should be made a definition or developed a definition of particularly risky products. So that's let's say my first statement. Please make the difference between the MiFID sector and the IDD sector, between retail investors and policyholders.
Yeah. So my thoughts listening to you is, first, we should not try to expand this category of particularly risky products beyond what is strictly necessary. You really target specific products that are indeed particularly risky and not general categories, and keep the differentiation between the IDD version for insurance products and the MiFID version. In any case, what we may to forget sometimes with the retail investment strategy is that it's one directive but amending different directives. So the IDD will remain independent from MiFID. So there will be coherence, but I think we will insist in the position paper on the fact that this definition of particularly risky needs to be adapted to the sector, and insurance on one side, packaged retail investment products on the other, and risk are different, context is different. Yeah. Any other reactions to what Christian just said? Okay. Any reaction to the digital by default change switch? I think that's maybe less controversial, especially since it's already the case for MiFID. Jella?
Digital by default, I think, sounds good to me. But does this exclude the right to ask for information on paper in general?
No.
The
right to ask for paper is ensured.
Okay.
Both in the existing MiFID and in the proposal for IDD.
Okay. And then with respect to where should it be embedded in legislation rather than the guidelines, I'm very much in favor of these technical standards because I think it's a good alternative, and it's a stronger instrument in my view than the guidelines. So maybe we can go for that because it's probably clearer than waiting for the guidelines from ESMA or EIOPA.
Okay, thank you. Okay, so if there is no other reaction, I suggest we move to content of cost disclosures. So I will show a summary of what the proposal is for MiFID first, and then highlight the differences with the proposal for IDD. So cost disclosures in the MiFID proposal mandates that cost items are to be disclosed in good time before the service was transactioned. That is not changed, but still vague. We don't exactly know what in good time means, but you can infer that it means sufficient time for the client to actually review the material that is given to them. But there is no specified number of days or time in the proposal or in the existing legislation for that, as far as I know. The aggregate cost information is to be given so that the client can, I quote, understand the overall cost and the cumulative effects on return, which I think is a positive thing. And they are to be, so the distributors are to provide an itemized breakdown upon request. So it's not automatically given, but any client who wishes to receive that detailed list of cost items will be able to ask for it. The only exception is third-party payments, so including inducements, which will always be given in an itemized way separately. So you won't have to ask for it, that will be automatically given. And disclosing the cumulative impact of those third-party payments on the net return over the holding period. So that's where really the proposal really wants to stress transparency on third-party payments, as an alternative to a full ban on inducements that we discussed yesterday. We see really that will of the Commission to shed light on third-party payments in there. Whether that makes this information actually actionable or useful for the retail investors, that's an open question, and I will welcome your views on that. Then, so all the amounts are to be expressed both in currency and in percentages that are to be calculated to the maturity date of the instrument. Remember, we're talking about MiFID products here, or the recommended holding period. And if there is no recommended holding period or maturity, then to be calculated to 1, 3, and 5 years. So, and if the amounts cannot be calculated before, then what is to be disclosed is the method for calculating. And the proposal says in a clear, understandable way, which might be a challenge. To do all that, providers are to use standard format and terminology that is to be developed by ESMA in, I don't think it's delegated acts, I think it's a regulatory technical standard. So now differences with IDD. So on the cost item to be disclosed, we have the same, basically the same things, but we add the duration of payments, which in my opinion is actually a very important information to know for how much you're going to pay, but also for how long, especially when you're talking about ongoing charges. The distribution cost and cost of advice are explicitly mentioned as cost items to be disclosed, which are on which the MiFID version is silent. It doesn't say whether those two items are to be disclosed. And on the last point, the use of standard format and terminology, the IDD version also says that cost items are to be accompanied by an appropriate explanation of their impact on expected return. So here we have a bit more on the IDD side for EBIPs than we would have on the MiFID side. In terms of coherence and alignment of the two pieces of legislation, we have an issue. Now, is it necessary to go to align the MiFID version to the IDD? I welcome your views on that. So first question, for products with a maturity date, should the overall cost also be calculated for 1, 3, and 5 years, just for comparability? Because if you compare a product with a maturity date and a product without a maturity date, then you would not have the same, calculations, the same periods. So should we also have, in all cases, 1, 3, and 5 years, so that you could compare for those periods? Should MiFID also explicitly mention the distribution cost and cost of advice in the list of items? Are there reasons not to mention that for MiFID products? And finally, should the MiFID also require the provision of an appropriate explanation of the impact of cost items on return? So I give you the floor. Any reaction? I saw Christian disapproving on my first question.
Okay, thank you. If you ask me so directly, no, I didn't disapprove. I think this whole discussion on the cost disclosures simply show the differences between the retail investor sector and the insurance or life insurance sector, especially. First of all, of course, the duration of payments is absolutely necessary, at least for the insurance sector, because let's say there are only very few products, insurance products, which in the life insurance sector, for which you can make a one-off contribution. This is, in fact, I think there is only one example. These are the so-called immediate annuities. So these are these annuities for which you can just make one payment, and then the payouts, the pension payouts, will start immediately. So this means that the accumulation process is not part of the contract of the product. In all other cases, of course, you have this duration of payments, and especially with regard to the costs, so the distribution costs, they are usually always calculated in relation to the total sum of premiums that the policyholder pays from the very beginning of the contract until maturity. So that is the usual thing for life insurances. And so that is why first duration of payment is absolutely necessary, and the costs of the distribution costs have to be calculated related to this total sum of payments. So that is what I've said, that is the usual thing. And for example, now in Germany, we have, in the insurance sector at least, we have the discussion now with regard to the itemized breakdown. This is quite usual in Germany. We had the reform of the insurance contract law already in 2008, and there it was already clearly defined that the total distribution costs had to be disclosed as well in the KID as in the contract itself. So the discussion that we have now, which was accelerated by the proposal of McGuinness to disclose again these the prohibition or the interdiction of commissions, there's a confusion. So what is clear that as well to the German law as now to IDD, it is the total sum of distribution costs This does not mean that the commissions are disclosed, because there are many other costs like advertisement or simply for the office of the distributor, so on. They are included in these total distribution costs. So that is, I think, and now let's say there is a kind of propaganda against the proposal of McGuinness, that she wants to disclose the commissions. And of course, this is wrong because this is not included. So that is a kind of really misleading propaganda which is still going on. And they even have engaged professors of judicial faculties and so on in order to prove that this proposal is wrong. So we must be very clear that distribution costs are always aggregate costs. And only if the policyholder really asks the distributors, please make this itemized breakdown, then of course he has to do it. So this was in the former German law as well the case, but only by, as you have said, on demand of by the policyholder. And I think that is okay. That this is not a change, and this is justified
but actually
to regulate it in this way.
Yeah, actually, in the proposal, if I read it correctly, the commissions to the third-party payments will have to be disclosed even without request automatically. So that's going further than the German law in that case.
Okay. Then we will see that. So then again, what here with the itemized breakdown, that is one part. Another point is with the recommended holding periods. I think here too, that is an important difference between the retail investor sector and the insurance sector. Life insurance sector. For life insurance sector, the periods, the proposed periods of 1, 3, and 5 years are not appropriate. This may be, for example, the period of the recommended holding period of 5 years. That is, let's say, that is the only one which I agree with, which should be taken, because after 5 years, usually the distribution costs are finished, and they have to be paid within 5 years, and then the full effect of distribution costs, which reduce the investment part of the premium of a life insurance, this full effect is shown. So do you understand that? So usually it's not a one-off payment of distribution cost. It is let's say prolonged on 5 years. So then the full effect on the reduction of the investment part of the premium can be shown. But again, then the investment parts will grow, will rise, because these distribution costs do not have to be paid anymore, just the ongoing administration costs. So costs are reduced.
Yeah, if I understand well, so for life insurance policies, the distribution cost is moved out on several years, so you can't take a snapshot at 1 year and 3 years. So it has to be longer. Okay.
Yeah, because the contracts usually last at least 12 years or 20 years or maybe even 30 years. So that is we have here completely different durations. And again, if I take an investment fund, okay, I can make my investment and just be in for 1 year, 5 years, and so it just depends on the performance of the investment fund, how long I will stay in it. But with an insurance contract, it's different. It is fixed from the very beginning, and if you make an early cancellation, then you have to pay penalty fees for the early cancellation. So this means that the legal construction of the contract is totally different, and I think that should be reflected as well.
So thank you, Christian. Jela, you wanted to add something?
Yes, could we go one chart back to the MiFID, please?
Yeah.
Exactly. I'm very much in favor, seen from the investor perspective, that we will have an itemized breakdown of the costs with regard to third-party payments, inducements. I think it's a very important point for us. And I'm very glad, and we should be very supportive of this proposal. And I think, Christian, this should be the same for IDD. I mean, there we should go in the same direction. So that's very important. And another question for me is, because I was looking in the paper you sent us, the 49 pages, and here the question Q16 was regarding financial instruments without a maturity date. So I'm a little bit confused, because in the next chart you asked for financial instruments with a maturity date. And I think that's a big difference, because if you have a maturity date, the question is, do we really need further information? I mean, this is a little bit going the same direction as Christian said. I mean, if you have any life insurance contracts, they are usually fixed in length, you know, and what is the value of an information on 3 or 5 or 7 years if this is not the case, you know? Usually they stick to, I completely agree, to 10 years. So it's a big difference if you have a financial instrument with a maturity date or without a maturity date. If you don't have a maturity date, it makes sense to give more comparisons for 1, 3, or 5 years, but not if you have a maturity date.
Yeah, the current proposal is that you would have the 1, 3, and 5 years only if you don't have any maturity date or recommended holding period. If you have either maturity date or recommended period, then you don't have the 1, 3, and 5 years.
That makes sense.
Yeah, the answer to the question was, if you, as a prospective investor, want to compare two products that have different recommended holding periods or different maturity dates, would you need to have those intermediary steps to help you do the comparison? But it's additional information, and we are talking about a lot of information already. So
and that's also a point I wanted to raise. I mean, everything is going more or less as far as I understand, in the prospectus or in the key ID. And I mean, everybody's complaining that the key ID is too large, too long, and so on. So we also have to be constructive, I think, and I have to tell, yes, this is information which is key. I believe inducements is key, for example, as information, but there's other information which I do not really, and that's probably 1, 3, or 5 years, which is, not, in my view, not as essential. And maybe we should also propose where we could, delete some information in the key ID, because it shouldn't be too long as a document.
Yeah, definitely agree. Ben, you wanted to intervene?
I just wanted to explain why in Belgium this is a thing. Because the recommended holding period has a fiscal impact. And so it's a very short, I think it's only one line, but it says if you sell the product before the recommended date, the recommended holding period, then there is a fiscal tax of X%. So it costs you a large part of your revenue if you have to keep it for 8 years in order to get the fiscal benefit. Then getting out at 7.5 years, for instance, or 6 or 5 or whatever, is going to cost you a lot. It's a small information, but I assume it's this kind of information that they're looking for.
Yeah. And then going back to what Jelle was just saying, I think that in particular, that's particularly useful information. If there is, a tax incidence of going up to the recommended holding period or not, then that should be mentioned. But if there is not, maybe we can delete. Christian, you wanted to add?
Yes, thank you. Just one point. Of course, I agree with what Jelle has said, that we should think about possible reduction of information points which shall not be disclosed. But I have one point, in fact, where I think an information should be added to the KID, and that is what you have written here with regard to the cumulative effect on return. This is in the insurance sector, at least, it is called the reduction in yield. I don't know if it is the same figure for the securities. And this reduction in yield is just is based on an assumption of the possible yield which the insurer or the investment company think that they will achieve with this product. So in insurances, usually this is linked to a certain interest rate of the yield, which they assume to be, that they can achieve it in the future. And we had examples that, for example, British life insurers, like for example, Standard Life was one, who offered life insurances in Germany. They, in former times, they disclosed this interest rate. So they disclosed the interest rate for the calculation of this cumulative effect on returns. And with the reform of IDD in 2018, this had been abolished. Not directly, but let's say the directive does not ask the insurers to disclose this assumed interest rate. And I think that is very necessary for the policyholder to understand which are these assumed interest rates. In fact, now they call it performance scenarios. But the scenarios are just let's say, written or exposed in a very general way without giving any detailed figures. And I think that is, well, in BDB, let's say, I clearly can say this is really the position of our association. We clearly think that this assumed interest rate, which is the basis for the cumulative effect on returns, should be disclosed.
Yeah, I think we can agree on the fact that if you use reduction in yield or performance scenarios, you, as a provider, should put at least a link in the information given to investors to access, the assumptions and the methodology. Maybe not put it in the document itself, but at least give the possibility for a consumer or an advisor, for that matter, to go and check how you assumed what assumptions you made for your calculations, because this is key in defining your performance scenarios and the figure that you will show to the prospective investor in cost disclosures and in the KID. I think we will have to come back to that when discussing the KID. I was just wondering, and I don't exactly remember whether the proposal specifically mentioned reduction in yields. I think it doesn't. And then it would be left for ESMA and EIOPA to define in their technical standards what metrics can be used, and then for each metrics, what assumptions have to be disclosed. But we will have to be particularly vigilant about that. Not sure that this level of detail can be, inserted in the directive itself, because that would be preempting, anticipating a lot on the authorities' work, and probably legislators would not feel comfortable defining that in level 1. But that's just my thinking so far. Any other reaction on this item of cost disclosures? Yeah. Okay. So then I will have a very long table, sorry, but it's not 49 pages, on the annual statements on cost and performance. So here we're not talking about pre-contractual, we're talking about annual information given to the client, to the investor, in both MiFID products and insurance products. So the new requirement for both MiFID and IDD is to draw up a concise, personalized document containing key information that is to be provided annually to each client or customer, because IDD says customer, MiFID says client. So I've made a table, comparative table of the different items that have to be included in those statements for MiFID, for IDD, with some comments. The first item is basically you have to include all implicit and explicit costs paid annually by the client. That's for both. Difference is in presentation. MiFID doesn't require an itemized breakdown of that information, just a split between cost of the investment or ancillary services given by the distributor, the cost of the management of the financial instruments themselves, the cost of the units, instruments, investment vehicles, and payments, again, we find our inducements, payments received from or paid to third parties in connection with the investment services. So here, understand inducements, commissions. IDD asks for an itemized breakdown of that information. And it specifies also difference with MiFID that this information has to be given for the past 12 months, but also on a compounded basis since the start of the contract. So my reading of this is that the IDD version might be superior in terms of detail that you can get, but it can also be a bit overwhelming in terms of quantity of information that you get with the itemized breakdown. The split between three categories might be sufficient, and you could ask upon request to have the itemized breakdown. And I think the complement of having the cost items, for the past 12 months and since the beginning of the contract might also be useful information. See how much you have paid for each of those services, for each of those features since you signed for that insurance policy or since you bought this instrument. So I do point B and then open the floor. So there is the amount of cost and also as point B, the total amount of money that you received from your investments. That's only for MiFID. The total amount of dividends, interest, and any other payments received by the client for their portfolio. There is no equivalent in IDD. That's really an open question, but would it be meaningful to have that information also for insurance products? Is there any sense of asking for that, or is it something completely useless? And on that, I open the floor and I see again Christian nodding. So,
I did not raise my hand, but okay. Yes, okay. I think it's a very good question that you have asked, really by asking, does it make sense for our insurance sector? In fact, I do not fully understand how this could be included in the insurance sector, because in insurances it is quite clear that you have, for example, when you have a guarantee, then this is, of course, then the guarantee is, let's say, is based on, of course, the total amount of any kind of yield that the insurer can process or can have of its investments. And if the yields that the insurers can have from its investments go beyond the guarantee, then it is simply part of the bonuses, and in fact it does not. It is, let's say, the source of this additional yield is not so important. That for the policyholder. At least now I only can speak for Germany, and we have very clear legal prescriptions or legal provisions. What are the percentages of the percentages of the yield which have to be given to the policyholders depending on the source. For example, if these are, as you have said here, the dividends and the, let's say, any yield coming from the capital markets, 90% have to be given to the policyholders. But if the yields, for example, are coming from an overcalculation of biometric risk, that, for example, the death rate is lower than expected, or the life expectancy is a little bit lower than they had calculated, then only I think it's only about 70% which has to be given to the policyholders. So the sources of the yield which have to be given to the policyholders as bonuses may be different, but it is sure simply that they have to be given. And I think you could not put it in an annual statement. It really, that's an information I think which would be too detailed. I would say. It simply it is the task of the authority, of the supervisor authority, to really look into the books of each life insurers and then to say that's okay or not.
Okay, Jela?
I agree with Christian. I'm not an expert on IDD, but it seems to me that this is very detailed information. And I mean, it's always good to have information, but sometimes it can also be too much, and it should be the essential, the key information. So I'm not sure whether we should ask for more detailed breakdown information regarding MiFID, just because IDD is going for it. I think the most important is that you can see the costs and that you can see the inducements. And I don't know if for the investor it's really an advantage to have all these detailed breakdown of costs.
Especially since you can still ask for details upon request. So
yeah, exactly. So
okay. Then so I don't see any other hand. Okay, so I stopped putting the letters on those items. So point C, the first line. So in the annual statements, you also will need to give the net annual, talking about MiFID, the net annual performance of clients' portfolios for the whole portfolio and for each of the products in the portfolio. On the IDD side, you would have basically the same information, the annual performance of the EBIP, so the whole package product, and the annual global performance of each of the underlying investment assets within, so the units that are the core investment part of your EBIP. The differences between the two is that the IDD version requires a comparison with performance over previous years, which MiFID does not. So in the MiFID statement, you would just have the performance over the past 12 months, while in IDD, you would have that plus a comparison with the 12 months before and before and before. How many years is not said. I think that detail will be left to delegated acts or technical standards on the statements. But my first question for you is that a good idea to have this comparison over several years? And since at Better Finance, we've been advocated for real performance data, taking into account the inflation, the effect of inflation, should we ask that performance corrected by inflation be also disclosed, or inflation data, a reminder that inflation reduces returns? What kind of information related to inflation should be integrated in there? On total taxes, each of the two statements requires that the information about how much taxes have been paid were levied by the intermediary, so by the investment firm or the insurance company, is communicated. the IDD version requires a split per tax, which might be an overkill in terms of how much detail you have. You are interested in how much you have paid to the state, but what precisely tax you have paid might be a detail to be provided upon request. So hence my question, so it's positive to have a split per tax, but is it actually useful for all retail investors? Third item is the market or estimated value of each financial instrument in the portfolio. We have the same thing in IDD, market or estimated value, estimated when market value is not available. So that's equivalent. And an item that is only in the IDD version is payments made by the retail policyholder into the EBIP over the past 12 months. So all the investments, extra investments, deposits, contributions, premiums, fees, etc. From my understanding of the differences between MiFID products and life insurance policies, I really understand the necessity to have that into the IDD statement, but can't we imagine also a use case for that information on MiFID products if there are regular payments made on those products, on those portfolios also? So any reaction on those 4 items? Yes, Yela?
Yeah, I guess I start. I think it's one of the key demands as Better Finance. We were always asking for the past performance, as I remember correctly. So I think it's very good that IDD includes this information, past performance over previous years. The question is, what should we ask for? 1, 3, 5 years? I don't know. Of course, it's past performance, which doesn't say anything about the success of the products for the future. But I think it's quite a strong indication whether the fund manager performed in the past or not. So I think I'm a fan of past performance information. And that's why I think it should also be good to see it at MiFID. And since inflation is also a key issue of Better Finance, if I look at the real return study, yes, we should also ask for at least for some data on inflation, because of course it has a direct influence on the return of the investment.
Yeah.
I would not be as much into the tax issue. I think it's important to know how much you pay in general for taxes. But I don't know if you need a split per tax in detail and if this really helps.
So just to react on the issue of number of years, my mind, so it's not said in the proposal how many years it would be. I guess the most sensible way to go with that would be to have a number of years that is longer for longer term products. Also reflecting the investment horizon of people who invest in a life insurance policy for their retirement. They, would like to be aware of returns over the long term, because they won't sell that product. They won't, just surrender that policy just because 1 year of returns is bad, 2022, for instance. So, Ben, you wanted to intervene?
The discussion we had here was we would like to see past performance, but the discussion was net of fees or fees included. It would be interesting, but there the industry said it's hard for them to know which fees, for instance, the fiscal fees, but even without them, if you were to say an asset manager or an insurance company claims to have a return of, let's say 5%, but the customer only gets 3%. So
yeah,
if net performance might be an idea to ask.
Yeah, but,
which is difficult as an international standard, because it might be different in France, in Belgium, in Germany. I know, but still.
Yeah, I think we may ask our favorite option to have, net performance, net of charges, and, accept as a second best if we are really opposed on that point, to have it, gross returns, and that would already be a step forward. And then in a future revision of the legislation, we may ask for cost, net of cost. But yes, definitely, ideally, it should be net returns as always. Christian?
Yes, thank you. Maybe just a very short remark from my side. So the life insurers have to disclose the bonuses which they are willing to give to the to the policyholders anyway. Yeah. So this is it depends. Okay, I mainly can speak of the German market. We have then the differences between bonuses which are guaranteed and bonuses which are still free until the end of the contract. Now, so the bonuses which are then guaranteed by the insurers, they have to, and they do disclose it, and they have to disclose it. So this is, so you, it is not written just in one document, the past performance, but the information are available. And so that is why this is no, but it would be too much. Sorry, was my next point. It would be too much to ask for an annual performance of each underlying investment asset. That would be, for the insurance sector at least, that would be too much. The global performance, yes, but not for each underlying investment. And again, with regard to the inflation, I don't think that it is that is appropriate. It is, I think, that is a general figure, and that should be enough. It should not be part of this annual statement. Yeah, that would be an overload of information, as we may say. Yeah, that's my point.
Okay, I see Elizabeth agreeing with that point. Thank you. Any other reaction? I don't see everybody, so raise your hand if you want to add anything to the discussion. So more on that. So the IDD statement, and feeding into what Christian just said, is actually a bit longer in its the proposed version than the MiFID one, because it also requires adjusted individual projections of the expected outcome at the end of the contract or end of the recommended holding period based on the current value of investment, the performance to date, hence the requirement to have the information on performance, and the KID performance scenarios that we already talked about. So the first question on that is, could we have similar investment projections be included in the MiFID statements? Also considering that the investment horizon might not be the same, might be shorter, and exiting contracts is, well, just selling instruments is has a bit different conditions than on life insurance, and should Betterfine support the inclusion of such individual projections, knowing that we are generally critical of the performance scenarios in the KID based on 5 years past performance and non-disclosed assumptions. So should we really, do we really want to give a wide check to the Commission on that part? I follow the next item. So there is also information on conditions and financial consequences, very important, of early termination of the contract or of switching providers. That must include the surrender value and the conditions for surrendering the policy. And finally, the statement must include a short summary of the insurance cover provided with the EBIP, which of course is insurance specific, doesn't make sense to have that for MiFID products, except if the MiFID products also include guarantees, in which case we might want to have that also. And for the information on early termination, should there be an equivalent information in MiFID statement? Ben mentioned, the situation in Belgium where you pay more taxes if you sell your investment before the 8 years. Should that information, be provided in the statement for MiFID, or also in other countries? Yela, I see your hand.
Yes, I think these are all very much insurance issues, to be honest. And I have some problems to transfer this into the MiFID world. So I don't know, I think in all three cases, this is typical for insurance, for, let's say, for example, life insurance, where you have a certain maturity date and where it is very costly and inefficient to terminate the contract before. So for me, that looks very much like rules for insurance sector. And I cannot see how we can transfer that directly to MiFID. And when we come back to our critical approach regarding performance scenarios, where we actually say as Better Finance, it doesn't really help. So I would be skeptical if this would be really such a great information for investors, but it would be great to hear others on the issue.
Yeah. Thank you. Any other reaction? Yep. Then point taken. So the last item, also specific to insurance products, is that if your EBIP has in its policy term provisions that foresee a periodic premium reviews, but then information about the projected premiums that are required to maintain the existing protection benefits until certain ages have also to be communicated. So just the same as the previous slide, this seems like really life insurance specific information. I don't see, but as far as I know, any equivalent need to have the equivalent information in MiFID. And I note also that this information, which they want to have in the annual statement, is not including in the list of items to be communicated with the pre-contractual disclosures. So in pre-contractual information, at least in the list that is proposed currently, there is no point on this particular point. Should that be also added to pre-contractual information? Any thoughts? Yes, Christian?
Yeah, I have a little bit of problem first of all in order to understand what is really meant by the notion periodic premium reviews. So the only thing which I know from our market, at least, is that there might be included in the contract from its very beginning a so-called dynamic. So a dynamic, this means that there's a regular increase of the premiums, for example, 3% or sometimes even 5% and so on, which is made automatically. But this is part of the contract.
Mm-hmm.
But only in this case, then you have this review or periodic review. I do not know any other case. Of course, now with new contracts, a policyholder can ask the insurer, for example, by stating or by asking, "I would like to increase my premium," and then. Now, but then often it depends, I think what Ben has said with the tax regime, this might be considered even as a new contract, depending on the amount of the increase of the premium, and then you have to pay additional taxes, or even sometimes even distribution costs. So that is a question then again of advice and quality of advice. If the advisor has really given a good, a good neutral opinion or advice on this question. So I do not really see what is meant by this expression. And of course, again, at least to the insurance contract law, these projections on the different ages, not exactly 55, 65, or 75, etc., but at least for maturity, are obligatory, already obligatory. So that
I
is,
think
that is the point which I wanted to make.
Yeah. My understanding of this item is really the first case you mentioned with this dynamic, premiums. That, also considering, evolution of inflations and so on, you may have contracts that already foresee that to maintain a certain level of retirement income, then you may have to increase your premiums at some point. And then the information that should be included in the annual statements is where, I guess it's not clear really from the proposal, but at least whether a review is due soon and how much the premium should be raised, and the method that is used for calculating that. But indeed, that's for a subset of life insurance contracts. Yeah. Okay, so now that's all for the items to be included in the annual statement. So it's going to be a long document that we will all receive either in emails or in paper. And now talking about the format of those provisions of statement. So the MiFID version, we have a discrepancy here in terms of requirements. The MiFID version is silent on both the format and the cost of providing those annual statements. The IDD version says it has to be free of charge in electronic format, and a paper copy is to be provided upon request, but it's silent on the cost of the paper version. What we would suggest is that we specify in both that electronic format is a default, free of charge, and a paper version is to be provided upon request, also free of charge. Yes, we don't like to pay. So, first question, do you support the proposed insertion? And before I open the floor, just mention, so there is also in the proposal a waiver of this requirement to provide an annual statement. So a possibility for provider not to give the annual statement if they give the client an access to an online system which qualifies as a durable medium. So I guess it means you can download the information on PDF or something, where up-to-date statements can be accessed with the required information, so the list that we saw before, up to the date of consultation, can be easily accessed by the client, which raises a lot of questions in terms of what is easily accessible in terms of online platforms. And the firm has evidence that the client has accessed those statements at least once in the previous 12 months. So if you don't use that online system, they would still have to send you the annual statement by email or on paper. So regarding that online system, should the directive include further definition of what easily accessed mean? Because if it's actually something that requires tech-savvy users, it might exclude a lot of people. And should the conditions include the requirement that the online system includes a feature to download the statement. So even if you have access and even if you use that access, you may want to have the possibility to actually download that information and store it on your own drive, like you can do with bank statements. Any reactions to that? Yeah.
I'm very much in favor of both proposals. I think it's a good idea because easily accessed, we don't have that many good experiences. Because when they say easily accessible, it's usually difficult to find. And so I think it's a very good idea. I'm very supportive of both proposals.
Thank you. Any other reaction? Christian?
Yes, thank you. Just for clarification, right now, at least for the German insurance contract law, there is a legal obligation for the especially life insurers to send this annual statement by post, as in paper version to the client until now. That is very clear regulated in this insurance contract law. So if the Commission wants to change that, then of course the national laws have to be changed as well. With the possibility of a waiver, I would say there should be a minimum condition that the insurer has to send at least an information. This means an email to the policyholder that there now is a new statement, and exactly to tell him where it is accessible, where to find it. This could be maybe a compromise. Generally spoken, I fully agree with the concept that digital access should have the first priority.
So if I, in practice, translate what you just said, it would be sending an email to the client saying there is new information on the online platform. Please go check it. Here's a link. Here's how to connect. Right? Yeah. It seems like a proposal that we can definitely make. Anyone else want to come in? No. Okay. So insurance-specific information. Again, the proposal creates a new insurance product information document, or an IPID, for life insurance products other than insurance-based investment products. So for EBIPs, you would have a KID. For non-life insurance, you already have an IPID. What the proposal wants to create is a specific IPID for those life insurance products that are not EBIPs. So the idea would be to provide potential clients with an IPID that is specific to that class of products. And in terms of the products concerned, I really had to dig into Solvency II and the IDD to actually understand what products are covered. But my understanding is that all classes of life insurance that are listed in Annex 2 of the Solvency II Directive, which are not EBIPs, meaning that their maturity or surrender value is not exposed to market fluctuations. So you don't invest, those products do not invest in capital markets. That would be the difference with EBIPs. The actual proposal gives a list of examples. It does not give a full list, because probably too problematic to put that in legislation, a full list of products that are concerned. But in terms of products that are, I have notes here, but I'm not going to use them. So in terms of the content, there is a long list of items which is similar to the existing IPID for non-life insurance products, with some adaptations for life insurance. So I show you the list. Don't specifically need to read it now, but you have information, type of insurance, summary of insurance cover, means and duration of payments of premiums, means of calculation and distribution of bonuses, main exclusions, information that is relevant to an insurance contract in general, and indication of surrender and paid up values, right of cancellation. We already talked about how important it is, and tax rules applicable. So law and competent jurisdiction and so on. In terms of the presentation, the details are to be left to implementing technical standards that are to be developed by EIOPA, which is, in my understanding, similar to the requirement for the non-life insurance EPID. So something that is new but not really new. It's really an extension of the existing EPID, but with another class of products, which is a bit difficult to grasp. So 3 questions in one box for this one. What are your views on this new EPID? Is it necessary? Is it a good addition? Is it useful for clients buying those policies? Is the proposed content sufficiently exhaustive? Because as not an insurance expert, I really can't say whether they're missing something. And is the scope of the products concerned sufficiently well defined? It might be difficult to grasp that from my slide, but I include more details into the 49 pages document that I sent you. But I can, if need be, send an accept by email. So our insurance experts, I want to react. Christian?
Of course, yeah, thank you very much. It's again me. Yeah, so I think the idea in itself, let's say the criteria which are listed in this, or as information in this new IBIP are not too bad. But the decisive question is, which are the products for which this new IPID can be used for. So that is, and I really don't see any products. For example, if you have life insurances which are not IPIPs. So this means life insurances which do not include an investment part of the premiums. The only example, which is a well-established example, are of course these so-called term life insurances. This means life insurances which only cover the risk of death, the biometric risk of death. But then it is clear that you pay for a certain duration, contract duration. You pay regularly a certain premium, and for this premium, you will receive from the very beginning of the contract or until the end of the contract, you will receive, in the case that the insured loss, this means the death occurs, you will see the contractually fixed sum. For example, 50,000 euro or 20,000 euro, whatever. So that is quite clear. The sum which you will receive is fixed by the contract, and it will be paid by the insurers only after the first premium or just at the end of the premium. If the insured loss does not occur, then you will not receive any maturity sum, lump sum at the end, because there is no investment part included. Otherwise, the premium, of course, would be much higher, and you would simply have a classical life insurance, which includes both dimensions. So that is why I do not really see for which product these new IPIDs can be used for. And already for the term life insurances, the IPID which exists already now is used, and this does not pose any problem. So, and again, now other products, which the other live products, which the Commission has already excluded from being an IBIP, are these immediate annuities. Because immediate annuities, as I already had said, they do not include the accumulation phase. You just pay a lump sum, and from that moment on, the pension payouts start without any accumulation phase. So for this, maybe you could say that this new IPIT could be used for. But again, here, for example, you do not have any maturity, because a pension is an annuity, and the insurer pays as long as you live. So. Yeah. So again, my conclusion simply is, first of all, it should be the obligation for the NCAs, for the national supervisory authorities, to establish a list for each national market, because I think each national market is very different, and maybe there are some products which are sold only in France or in Ireland, or I don't know, in Spain, and
so have the
Germany.
Has the national authorities publish a list of products on their market that would be, concerned by this? Okay, yeah,
that is, I think, the main point.
Yeah, Actually, so if you read Solvency II in conjunction with the definitions of EBIP in the current IDD, the contracts we mentioned about covering the risk of death are indeed concerned. They are life insurance, not EBIP, so they would be concerned. Apart from that, there is no detail, but I find the suggestion to ask national authorities to draw up a list and review it regularly quite good, and we can ask that as a requirement. Any other reaction on that specific point? No. Okay. So let's move to the key information document. I'm trying to speed up. So there are relatively few changes to the KID, and it's mostly related to presentation. There's the introduction of a new product at a glance session, which takes information already included in the KID, but summarizes as a frame or box on top of the KID, including the type of the PRIP, the summary risk indicator, total costs, recommended holding period, and whether there are insurance benefits attached. First question, do you agree with this new product at a glance session? Of course, it's addition to the KID because it doesn't delete any other information, so it's more length, but it might be useful in terms of providing a very generic overview as an entry point to the document. Let's think also in terms of information layering in an electronic format. I will come to that, but that might also be the first screen you see if you access a KID in electronic format on an online platform. Second new section is the sustainability one, how environmentally sustainable is this product, which includes two indicators. First, the minimum proportion of the investment associated with economic activities deemed environmentally sustainable under the EU taxonomy. I don't know whether anyone outside Brussels really understands that sentence. And second indicator is the expected greenhouse gas emission intensity associated with the product. Might be a bit more straightforward if you don't dig into the details. So is this information sufficient and sufficiently understandable? And should it be accompanied by a short narrative explanation, which might be accessible with a link rather than including it directly in the document, but some more explanation on what it actually means. What we note also is that in the previous version, there was information on environmental and social sustainability. Now it's only environmental. Should it also address the S and G in ESG, so social and governance standards, or might be too much information? Okay, let's start with that. Do you have any views on those two parts? Yella.
Well, if I understand it right, this new product at a glance section is a little bit like a executive summary of the key ID, right?
Yes,
Which
yes,
is in
yeah.
front. So yeah, I think it's a useful thing, and there shouldn't be too much information in it. I mean, I understand that they want to focus on sustainability, and I think it would be better to have ESG, but then it would be much longer. So I don't know if that's a good idea. And I mean, to be honest, the minimum proportion of the investment associated with activities deemed sustainable under EU taxonomy. Very hard to understand for the normal investor. And if we look at the annual statements of this year or last year from the companies, maybe 10% have indications on EU taxonomy. So, I mean, I understand that they want to focus on sustainable information, but maybe expected greenhouse gas emission is more important and more easy to understand for the investor.
Yeah. So on this environmental section, the way they thought it is that companies should be able to reuse information that they will have to report under the SFDR in any case. So at some point they will fall under the SFDR, the obligation to report on that, so they could include this information into the KID. But yeah, in terms of understandability, we are discussing with some other civil society organizations, environmental NGOs, on how to make something that is both short, concise, but clear and understandable on those issues. We'll try to work on a proposal for that. Okay, maybe I move on to the rest of the KID proposals and then open the floor. So next review of the KID is removal of comprehension alerts. So currently, if you're reading a KID about complex products, you read a warning saying you're about to purchase a product that is not simple and may be difficult to understand. The European Commission wants to scrap that because they find it insufficiently effective, and they find that it actually discourages retail investment in less complex products, which may sound a bit paradoxical, but yeah. So what are your views on the existing comprehension alerts? Do you know about them? Are they actually useful? Could we do without them? And if they are deleted, should these alerts be replaced by some other warning about potential complexity? Okay, I complete with the reforms of format, and then we can discuss. So the format of the KID now will be electronic by default, just like we already mentioned for the annual statement and so on. Electronic format meaning any durable medium other than paper, which currently often means a PDF document that we will download. There is a stated right for the prospective investor to receive a paper copy free of charge, so that's already in there. And there is an obligation for the advisor to inform the prospective client about that right. So we don't see much of an issue with that. And finally, and that's probably where the Commission probably made the most work, they want to allow the use of interactive tools to present the information of the KID. So where the KID is electronic, you could use tools like a web app or something to generate personalized information. So for instance, it could ask you what is your horizon investment horizon, how much do you want to invest, and make a simulation based on that. There are 4 conditions listed. It should not alter the understanding of the information included in the KID. All the key information still has to be presented one way or another. It should include an easily accessible link to download the classic version of the KID, so the PDF. And it should allow simulations of costs over recommended holding period, so not only returns, but also costs. Do you think that those 4 conditions are sufficient safeguards? Are there particular elements, additional safeguards that we should have specified in the legislation regarding that? And okay, so just summarizing on the KID, so beyond this new sustainability section and product at a glance, the proposals regarding the KID are mostly about format and presentation, not so much about content. There is no review on, the ways, what kind of information is presented and the way it's presented, especially on, cost and performance in terms of comparability, understandability, the performance scenarios that we already mentioned. And it maintains the future performance projections as the main performance information that is provided, without any mention of any obligation to show past performance data or to disclose, even with a link, the assumptions that are made to calculate those performance scenarios, or even have them probability weighted, which to us is a big minus for that reform. Do you have any reaction on the KID?
Could you go one chart back, please? Yeah. No, even one before. Yeah, the comprehension alert. I think it is possible that the industry understood this as a deterring information. In general, I have a lot of sympathy with that, because what do we want? Do we really want the investors to attract them to buy structured products, complicated products? Not really. We want them to invest in simple products, or at least products that they understand. I think that's the most important. Maybe the comprehension alert that we have currently is not perfect. So yeah, maybe if we replace it by another small warning about the complexity of the product, that would help already, and not be as deterring as this version that we have currently. With respect to the next slide, yes, I think it is good that we. Do you think that's the question to you, actually? Is the paper version sufficiently protected? I don't know. But I think we should make it sure. And I agree with the 4 conditions regarding interactive tools. I think this could be quite attractive, especially for young investors.
So to me, yes, the paper version will be sufficiently protected with that as soon as. So the advisor would have to give you the KID in one way or another, and they would be required to tell you that if you want a paper version, they can send it to you, and it's free of charge.
Okay.
So we can't really go much further on that.
Okay.
In terms of the 4 conditions for interactive tools, I think we will have to see how this develops, and to me, it's difficult to, at this stage, foresee all the possibilities in which the KID information might be distorted by the presentation of an interactive tool. For now, I think those 4 conditions make sense. I can't really make a longer list of things that have to be complied with by a tool. But then I'm not a product provider, so it's a bit difficult to imagine what they can come up with.
Makes sense.
Yeah. Any other reaction? Christian?
Yes, thank you. I think the question of the comprehension alert is again a very good example of the differences between the insurance sector and the securities sectors, the MiFID II sectors. For us, it was always a problem. For us, when this means BDV, it was always the problem that we thought that life insurance is per se a complex product, and it is a complex product because it combines two different dimensions. The first dimension is the risk coverage, death or longevity, biometric risk coverage, and the other point, the other dimension is the long-term saving process. So these two dimensions are combined in just one product, and it has always been let's say, a demand from our side that that people should be conscious, the policyholders should be conscious that they, if they buy life insurance, they buy a product which is complex in itself because it combines these two things. And we had always said that it is better to buy two different products, just one product for example, the death risk coverage, and another purely saving product, like a bank saving plan or investment fund, etc. So the combination of these two dimensions makes the product in itself complex, and that is why a comprehension alert should be added to any kind of life insurance. But as we know, if you use this tool too much, too intensively, then it loses its effectiveness. So that is why I would make the proposal that at least for the insurance sector, we should use this comprehension alert only for those products which include a complex investment part, as it is defined, as I have understood, following to MiFID II. This, for example, could be hybrid products or unit-linked products or index-linked products. So all those insurance or IBIPs which do not include a guarantee. So that would be for me the criterion with regard to life insurances, and where a comprehension alert is useful, because this means the less you have guarantees, the more the risk from the capital market is transferred to the policyholder. Okay. So that is the point which I wanted to make. Thank you.
I guess we can also link it to products for which there is a warning about particularly risky products in the pre-contractual information. I guess it would make sense to also have a warning on the KID for those products. Yeah. Thank you. Any other intervention on the KID before we move on to qualifications of advisors? Yeah. Okay, so qualifications of advisors. So the proposals actually want to align the requirements for MiFID regulated advisors and IDD regulated advisors, mostly on the existing IDD regulation plus some improvements. So it would be taking the MiFID advisors to where the insurance advisors are, and then take everybody up a notch in terms of qualifications and competences. So in terms of the requirements on firms to ensure and demonstrate that their advisory personnel, so anyone giving advice to retail clients, possess the necessary knowledge and competence and maintains and updates. So that means, regular professional training, lifelong education. The proposal says 15 hours of training per year. Concretely, there is a list of knowledge items that are to be mastered. There is a full new list included in MiFID as Annex 5. And in IDD, there's already the Annex 1, which is amended to add some new things. The European Commission is given the power to review that list if necessary, if there are new knowledge items that are necessary. Think of sustainable finance, which was not a thing 10 years ago and now is necessary for financial investors to know. And the initial knowledge and the regular updates are to be proven by certificates. And the proposal just say that, proven by certificates. In terms of the new items that are added, especially to the IDD list, there are some very important things like key characteristics, risk and features of products, general tax implications, total cost and charges, which is a good thing to know for an advisor. And there is an existing section on minimum necessary financial competency, which is developed in terms of functioning of financial markets, impact of macroeconomic development, inflation, limits of forecasting, future performance projections, specific market structures, national, other ones, and valuation principles. Another item is knowledge and assessing customer needs. So how do you, assess the needs of a customer based on the information it gives you? And finally, sustainable investment. Those are really the new things in the list of knowledge items that advisor will have to master. Now, in terms of our analysis is generally positive of those newer comments, but is really 15 hours of training per year sufficient for advisors to catch up from the current situation? It's really unclear that for advisors that didn't have to meet any knowledge requirements before, just 15 hours per year will be sufficient to really acquire all that knowledge in the short run. So maybe we should ask for to rise this 15 hours threshold, at least temporarily, at least as a transition period, with evaluate the knowledge and competence of all current personnel and see what they're lacking, and in function based on that decide whether they need 15 but maybe 20 or 30 years in this year and the next 5 years, for instance, until they are really up to date. And it's also unclear what kind of certificate will be considered as proof of training. For now, based on the legal text that is proposed, a certificate of attendance would be sufficient. Of course, you can attend the course and not understand anything. So should we ask for something more stringent? And coming from an academic background, I could suggest a system like ECTS credits, where you validate credits if you have passed the exam at the end, passed the test, passed the quiz, whatever. So a certificate that you have achieved the learning outcomes and not just attended the course. And yeah, so that's my only slide on qualifications of advisors. So I give you the floor. Do you have any reaction on that? How much can we ask them to study in a year, basically? No reaction? Yella?
Well, since nobody is reacting, let me at least say a few words. I think one point is important. There should be a distinction between new advisors and experienced advisors, because I think if you have experienced advisors, they 15 hours is probably already a lot, but if you have new advisors, it's probably not enough. So that's difficult. And I like the idea that we do not only ask for the certificate of attendance, but somehow that they prove that they did something. I think that's a good idea. if we ask for ECTS credits or something alike, that sounds a little bit like, they have to go somewhere else for the training. And usually they have in-house trainings, at least that's what I hear. But maybe there should also be kind of not an exam or a test or something like this at the end, and not only the certification of the attendance. And maybe we should also say from the 15 hours, how many hours they should invest on sustainable investing. I think this is kind of a new thing, even for the experienced advisors. So from the 15 hours, maybe they should have, 2 to 3 hours on sustainable aspects.
Yeah. So maybe you could have something like a more detailed rule saying, for experienced advisors, 15 hours, but for people who started in the profession this year or in the past, for the first 5 years, for instance, of working that profession, maybe a bit more, like 30 years the first year, and then 20 years the next, and so on. Could refine that. Ben?
I think here new advisors have a curriculum for the first 2 years where they learn everything, and that is fairly mandatory because then they get the certification in order to be recognized as an advisor. But Jella, I don't necessarily agree that it has to be in-house because they get credits, I agree, just for attending. There's no test, but outside conferences. And I think that is where you expose them to new ideas and to sustainability, and not necessarily only in-house. In-house, they usually only take care of the regulatory requirements.
Mm.
So the credit system isn't bad, but I do agree there might be some testing of what they actually learned. And the more these trainings are now online, it usually is 2 or 3 chapters and then a little test to prove that you've actually read the chapters.
Mm-hmm. Ben, may I? So that's a regulation in Belgium, right? What you mentioned?
Here's the thing. It's not really regulation because the industry started doing that in order to avoid regulation. So it's general practice. I don't know, the licensing is required. So the first 2 years when you start being an advisor, you really have to go through this course material and do an exam and get your license. And it's fairly comprehensive. Everything after that, you need a certain amount of credits each, I believe, period of 2 years in order to maintain your license.
Okay.
But how you get those credits, whether it be in-house, external,
it's flexible.
Yeah.
Okay. Thank you. Christian?
Yes, thank you. Just a short remark from my side. The insurance sector in Germany, for example, before the implementation of the IDD, had established a voluntary initiative of professional training of 30 hours per year. So that was
Double
so
what
this,
it's,
but that was voluntary. It was not a legal thing. So they already had made that. They had taken that initiative, and it was clearly supported by, for example, the associations of the intermediaries. We have several associations of insurance intermediaries, and they all clearly said, please go to these professional training. So it is possible to have a higher number of hours per year that is asked for. And the other point is, I know from our fee-based insurance advisors, which are part of our association, they participate at these courses as well, and they say usually these in-house courses are more or less just lessons on product innovations. So it's more a sales training than a real. For example, what is missing is if in a certain branch of products there are new tribunal decisions or court decisions. So that is, for example, missing, and that is, of course, very important in order to know what are the new judgments with regard to indemnization or cost disclosure and things like that. So
Okay.
that, I think, in this sense, I think it would be very important to have a real control of the content of
So
these certificates.
External oversight in one way or another might be light, but should be there.
Mhm.
Okay, thank you. I suggest we use the 5 last minutes to go over client categorization, that we can then finish more or less on time. That's for once, specifically MiFID doesn't concern IDD. In MiFID, there is a possibility for retail investor to ask for a professional investor status, provided they meet certain conditions and a certain process is respected in the relation between the advisor and the advisee. So in the current rules, to be able to ask for this professional status, you have to meet 2 of 3 criteria. The first one is one we call the wealth criterion, which is the size of your financial instrument portfolio must be at least 500,000 euros. The 2 others are related to your experience, conducting transactions and holding such a portfolio. First one is that the client has carried out transactions in significant size on relevant market at the average frequency of 10 per quarter over the previous 4 quarters, previous 12 months. And the third criterion, client works or has worked in the financial sector for at least 1 year in a professional position, which requires the knowledge of the transaction or services envisaged. So basically, professional experience. Experience as a client or professional experience. Now, the proposal of the Commission is to add 1 criterion to that, to lower the wealth criterion, and to have a new criterion about education, so trainings. So this would give that the wealth criterion is halved, it's lowered to 250,000 euros. The second of the experience criteria is a bit expanded, so it's not only has worked in the financial sector, but also has undertaken capital market activities requiring buy and sell. So basically, you have worked in finance, but not in the financial sector. It could be financial manager in a non-financial companies, for instance, which big companies do derivatives and so on. And the new criterion that would be added is one about education, and it's that a client can provide the firm with proof of a recognized education or training that shows their knowledge and mastering of the relevant transactions or services, and especially their ability to understand the risks. So on that, I've been discussing also with other consumer associations. They have slightly different views than what we have, but for now, what we are thinking is that this distinction between retail or professional might be actually too binary, and you might be very experienced as a retail investor, but still not a professional. So should we push for an intermediary category of qualified retail investors? So you can get access to more complex products, a wider range of products, but still keep the protections of retail investors on most of your portfolio. Second, on the wealth criterion, we are wondering actually, does having a large portfolio in terms of size imply that you actually understand the risk? You can be rich and just not understand what you're doing. So should we is lowering that portfolio actually meaningful? Should we lower it even less or even delete completely that criterion? Is it meaningful? And should it be required that regardless of the size of that portfolio, the investors meet at least 2 of the 3 other criterion, so experience or education. And finally, on the education criterion, what knowledge would be absolutely necessary to be considered as, a professional investor? So what do you absolutely need to know before you can shed the protections of retail investors? And should the proof of recognized education be a university degree or, a degree, a certificate by a training center? What safeguards should we put around that? And finally, that's a lot of questions. Should the criteria exclude training programs that are provided by any entity which has close links with the investment firm? So any training center actually contracted by the investment firm to train their clients. Yeah. Any reaction on those points? Sari?
Yes, thank you. Yeah, I think it's a very good idea to create a new category for qualified retail investors, because I think the problem is when you categorize dentists like into 2, either retail or professional, like then basically I think it's good for individual investors to have the possibility to actually have an access to certain type of products, but just like for them to lose completely all investor protection as a result, I think is way too hard. And like, I don't think they're professional. I agree with what you were implying, like that the amount of wealth doesn't really make someone professional. They could have, like in Finland, there was years ago a court case like with the dancer or like dancing school owner, like who had a lot of wealth, and then it like basically based on advice was invested in a very risky way, and like he ended up losing a lot of it, and like so that person clearly was not a professional investor, even if kind of was like he was treated in that way in the beginning, but based on the court result, like then they ruled that okay, he was not like a professional investors. So yes, and someone might have won it in a lottery or something, we don't know. I think the amount of years you've invested is definitely significant. I've also seen some investment firms like just use like some sort of an internet survey that they do. Okay, answer these questions, and then we say that you're professional and like you can invest in this. I think that's like it's annoying for everybody, because like some people who actually are professionals like might just like somehow like think too much of the questions and not get them right, and then someone just by coincidence is like Googling results and like getting them right. So I think that means absolutely nothing. But like main point, I think like it's a very good idea to introduce this third category in the middle, like of qualified retail investors.
Okay, thank you, Sari. Anyone else want to add on that? Yela?
Yes, actually, I'm very supportive of Sari and her comments. I remember that we were sitting several times at the EU Commission, Guillaume and myself, and asked for this new category. At that time, we called it sophisticated retail investor or semi-professional. I think it's a very good idea, because if I take a look at our membership in Germany, to be very honest, most of them are not beginners at all. They have experience of 20, 30 years of capital market, and they are fed up by all the papers that they have to sign and that they are treated as beginners. They hate it. So I think it's a very good idea to have this new category. And with respect to the criteria, that's difficult, I think. But I agree, wealth is not necessarily decisive. I think it's experience and education. And the main question is, how do we define education and what do we really require?
Yes.
I mean, if I take a look at my son, he would say, hey, I have all these finfluencers. They tell me everything, and I have everything on the YouTube videos. And I don't think they will, go really to independent training centers for their private investments. So I'm not sure what we should ask at Better Finance, how such an independent education should look like. And independence is a key issue, because when I look at the German system, most of the financial education is done by banks, by the financial industry. And of course, that's exactly what we do not want, because it's not independent. So I think this is very, very difficult. to say, but we somehow have to give some indications what we expect independent education should look like.
Yeah, thank you. Christian Verbich wanted to ask. You're muted. Christian?
Can you hear me now?
Yes.
Okay, obviously it doesn't work with the camera, I'm sorry. Just for last minute, I would like to use this opportunity to inform you that we received a call from our government and Ministry of Finance regarding the retail investor strategy package. We already saw the responses of industry, and you can imagine that everyone else is really strongly against it. So I would be really glad, because today is a deadline, to receive this final proposals from Better Finance, so we can also use this way to send it through our representatives, our government, to Brussels level. And I really enjoyed this conversation and the points that you showed out. I wish you all best.
Thank you, Christian. Yes, I've seen your email. We will send you a document today.
Great, thank you.
Welcome. Okay. So any last reaction to client categorization? Because I think we are already a bit late. Christian Gulich.
Yes, thank you. Okay, from my side, just a very short comment. Of course, I fully agree with the proposal to introduce this new category of investors. And I think there should be only 3 categories which should be taken into consideration. That is, or mainly only 2, that these are the categories of traded securities.
Mm-hmm. Oh, sorry. Sorry, Christian, I think you're muted for some reason.
Oh, sorry. So again, I agree with this proposal for a new category of investors. I think there should be only 3 categories to be taken into consideration. Now, this is a number of years that the investor makes any transactions, then the quality of the different categories of transactions, different papers, different securities, which he is really trading, and of course, the number of transactions per year. So now the question of education, of independent education, I fully, of course, agree with what Jelle has said. It must be an independent education. But at the same time, if we introduce an obligation to follow even an independent course or independent consultant on these questions, I think this obligation itself is a tool to create mis-selling habits or mis-selling conducts as well, because then you, at the same time, if you create the obligation to follow any kind of a lesson, then you have the obligation to exactly control the content of it, and this is probably not feasible. And yeah, there are already so many opportunities to learn in the internet, serious ones and not so serious ones. So you can't control it. And again, I think no obligation, because this will just create a new occasion for mis-selling. Yeah. This time not the products, but the lessons.
If I may just interrupt you, so there would actually not be an obligation to have education, you know, for all cases. If you still have the experience, you would not need the education. You would still need to comply with only some of the criteria. So if we keep the 4, it would be comply with 2. So you don't specifically need education if you have well-for experience. And if we only keep 3, then you could, you know, meet the conditions 1 and 2 on experience and don't need education. So that's where I think we can be quite restrictive with education, and indeed make it, you know, insist on independence and quality, and as something that is, you know, proven.
Okay.
But sorry, I interrupted you. You wanted to.
Finish.
Anyone else for final comments? Okay. Then, so just to wrap up, we've talked about information to investors, qualification of advisors, client categorization. There is one issue that we did not cover in this webinar. It's a question of marketing communications practices and influencers. That's also part of the risk. We have less proposals to make on that, mostly because the proposals that are made sort of make sense. We can make amendments here and there, but our allies, especially at Finance Watch, are really into the question of influencers. So we would probably focus on our main key issues and leave them deal with influencers. But any question on that, there is information in the very long, document that we sent. So if you are particularly interested in those questions, I invite you to go to the section of the document on influencers and send me comments, even short ones. So
if there are no more comments, let me say thank you to Sébastien, because I think it was, first of all, the format was excellent, I think. Kind of new for us because we never practiced it before. But I think it was excellent because it was so complicated and so long. And very, very much thank you for the preparation of all of this, also for the slides and the precise questions. I think it's a really good thing that we should keep up in the future. So thank you, Sébastien, and thank you for participating.
So thank you for the feedback. It's really important for us to know what format works and what doesn't, and we will try to make more of those on other initiatives on the policy activities. Sari?
Yes, thank you very much. I also agree that this was very useful. I think many of us are having those national hearings that Christian was mentioning. So if there is any short summary of the main points that you'd like us to include in our opinions when we're being heard by our national parliaments, I think that would be very useful for us. Just I think now we went it through extensively, but I think just a couple of main points really when we prepare the statements in our national languages.
Yeah. So
right
now I'm preparing the position paper. Of course, the position paper has an executive summary and then more detailed proposals. What I will do is, in any case, circulate the executive summary today so that you can have that as a speaking points and refer to Better Finance for more details later on.
Great.
Especially.
Thanks a lot.
Thank you.
And hope to see you all in Vienna.
Looking forward to it.
Bye-bye.
Bye-bye.
Bye.
Bye-bye.
Thank you very
Bye-bye.
much.
Bye-bye.
Bye.